In this video, traders are going to look at a Forex scalping strategy using Keltner Channels. Stay tuned. Hey traders, warm welcome to you. Alright, so scalping Forex is a tricky business to be in. However, I recognize that for a lot of people, that's what they want to get involved in. They want to become good at scalping. They kind of want to be there in front of the screen, executing a lot of trades, carving out a slightly edge and kind of making, hopefully at the end of the day, having something to show for it. You're going to scratch a lot, you're going to make a lot, but hopefully the idea is that rather than your risk reward ratio being skewed in your favor, i.e. you're doing a 3-to-1 or 5-to-1, the odds of success are more in your favor. So you're working a lot of trades with a slim edge that over time is going to hopefully get you that equity curve to move up in your account balance. Now, before we carry on with this, guys, the dangers of scalping are you've got to be on the ball. You're very vulnerable to things that can go wrong in terms of the market just suddenly ripping. You've got to be very, very disciplined because you're not going to normally have time to put actual physical stops in. You have to have mental stops. You've got to be very, very disciplined in executing that mental stop. You've got to be very, very disciplined as well over trading because you're trading very frequently anyway. It's very tempting to overtrade. If you overtrade, that's just enough to dilute that thin razor sharp edge you've got. So just be aware, it's a tricky, challenging thing to do. However, there are some strategies out there that maybe can be utilized, tweaked and adjusted to kind of become more a broader strategy. It might even play part of multiple different strategies used. Maybe swing trade, maybe day trade, maybe there's an opportunity for you to scalp in a certain period of time. So one thing as well, guys, is that scalping is very much dependent on the spread you've got. You've got to have very tight spreads or very low commissions with direct market access and zero spreads. You've got to have a good internet connection and all the other things I talked about, discipline. So this is not a free lunch by any means. And if you're starting out in trading, perhaps this isn't the place to start. But if you're interested, maybe this will help. All right, so what we do here, guys, is we're trying to find a currency pair with a low spread first of all. So we're not talking about some exotic or anything. We're a low spread, or if you're trading directly on the exchange, if there's some kind of exchange, interbank exchange, you've got access to that, the low commission. So you want to really, your edge doesn't want to be hammered by costs because that's a big thing. If you're trading on a big spread, this is going to be a losing strategy for you. It's got to be very, very tight spread or very, very low costs. And what we're going to do is we're going to choose a time of day when the equity markets are closed. So the underlying equity markets are closed. So in other words, if you're trading pound, or the FTSE needs to be closed, either the FTSE cash needs to be closed. If we're trading a US dollar, again, the US stock exchanges have to be closed. So know your opening times, the same with the yen, same with the AUD, etc. You want to trade a pair where both of the underlying markets are closed. So if we were trading GBP USD, for example, let's say 1 o'clock in the morning, UK time, UK is obviously closed and also the US exchanges are closed. Now, why is this important? Because with scalping, with this specific strategy, we're trading a mean reversion type trade. In other words, we're trading something we're expecting nothing to happen during that period because there's no real money flow from, and no one's awake technically. Well, they might be awake, but the money's not awake. It's not flowing in as it's come out of equities, or there's not an options pit open. There's nothing else underlying apart from a little bit of two-way flow. And so that's what we want, because what we're trying to do with this strategy, and that's why I've got Keltner's, is we're trying to look for the spring to be stretched a little bit and to come back in, for it to be stretched and to come back in. To be stretched for whatever reason, a bit of execution causes the market to push up a little bit and then come back a little bit. And we're trying to fade those little extremes, and we're using the Keltner channels to try and quantify that and qualify the kind of framing around that. And we've got some stop rules and target rules as well. So yeah, and also one thing to note, guys, is that let's say we're doing that example, GBP USD in the middle of the night, say 1 a.m. to 5 a.m. Again, could be any pair that has that window where they're both closed. You need to make sure there is still at least decent enough range, again, to overcome your commissions and your spread. That's important because sometimes it's going to be very, very quiet and sometimes it's going to be a little bit more volatile. And again, you don't want to trade when it's really volatile because the edge is really the fact that there's nothing much going on and the kind of moves up and downs are really just the impact of execution as opposed to actual genuine supply demand shift. So choose a time frame, the equity markets are closed. Now we're going to look for 2 bars in one direction. So very simple, but we're looking for 2 bars in one direction. We're on a 1 minute chart here. Play around and have a smaller time frame if you want, larger time frame, use a tick chart, range chart if you prefer, but this is a good place to get started. Looking for 2 bars in one direction, i.e. 2 green bars on a 1 minute. So 2 1 minute or 2 minutes of move in one direction. That's what we're looking for. And the second bar must be outside the Keltner channel. And by the way, the Keltner settings are on 20 and 2, so that's going to be a little bit wider. Some things are on standard settings are on 1. 2 is increasing the width of the Keltner. We want it reasonably wide, but we don't want it too wide that we're never getting triggered. So 2 settings are 20 and 2 on your 1 minute chart. So this is kind of what you would look like. And again, go and check it out for your own pair that suits you and the time zone you're on. So you'd have 2 bars in one direction, and you're looking to trade the second bar that's outside of the Keltner channel, right? So as the market, let's say, comes down into here, the second bar that's outside of the Keltner channel, we're looking to fade that move. So it's got to be outside the Keltner channel, and you've got to have 2 bars in the same direction. So what you don't want is for something to creep and creep and creep. It's that second bar outside that is more important. Now it could be 4 bars in a row, that's fine, but it's got to be outside the Keltner channel. So for example, here you would be stopped out because actually the second bar is outside the Keltner channel, but there's a third bar, and that's more than likely going to be your ATR. Depends on what the ATR is going to be. Here, for example, you're okay. The bar's coming outside the Keltner channel, you're taking it long. Here, you're probably okay as well, because even though there's a third bar and you're taking it on that short there, the ATR is going to be quite wide because that's not a big bar. Same with this one. So you're trying to get a stretch, at least 2 bars in the same direction, and then outside of the Keltner channel. Now, once it goes outside the Keltner channel, if you want to wait for the close, or if you want to hit it, this is where you've got to add a little bit of flavor. You've got to add a little bit of your own intuition and price action reading here, and you're probably going to be reading as the price changes, a little bit of the tape, so to speak. You want to see it when it just drives up and then stalls. You don't want to wait too much for reversal because that's the edge. You want to see it go, you've got those 2 or 3 bars, you're outside the Keltner channel now, and price just stops. When price just stops, there's your execution, you're fading that move. Now, be very, very strict here, guys. Your target is going to be a 20 period ATR. And don't forget, it's going to be reasonably low still. So we're talking 6 pips maybe, depends on the range of the day, maybe even less. So, and the stop is going to be the same as your target. So what you're doing with this is you're saying, okay, well, I want to qualify and adjust my targets based on the volatility. So that's what that does. Rather than using a fixed X point stop and X point risk, which from evening to evening could change quite dramatically, you're adjusting it to suit the actual volatility at the time. So if it's that happens to be 5 or 6 pips, then that's what you're looking for, 5 or 6 pips. One thing, guys, as well is, so basically, you're fading the move. Your target is going to be 6 pips, your stop's going to be 6 pips. If the ATR is running at 6 pips, maybe it's 5 pips, maybe it's 8 pips, maybe it's 3 pips. You might also say, actually, I alluded to earlier, if it's too low, like it's running at 2 pips, it's probably not worth it, right? Because if you're paying half a pip to get in, the edge is pretty low. So you use your own judgment on that. Bars in the same direction, outside the Keltner, when price stalls, we're looking to fade it. Do not ever add to a position. You will blow up if you do this, and it will be tempting because you'll see a price go, it'll keep going, and your temptation will be, well, I want to add to it because that means it has to come back a little bit and I'll be fine, and it'll be the one time you end up adding and the thing will just carry on ripping. There'll be some sort of news that's come out, and bearing in mind, guys, it doesn't take much in these early hours, for this example, for price to move significantly, relatively significantly, because there's not much liquidity in the order book. So let's say there is some news coming out that starts to hit the wires and people start to put some positions on. You could easily get a 60 pip move when you're looking for 4 to 5 pips beforehand, and that will just rip your face clean off. So do not ever add to a losing position. Be very strict. That's why we have fixed target, fixed stops, because you just want to be able to go click, I'm out, click, okay, loser, winner, loser, and be trading in that thing rather than thinking where's the stop, rather than judge always above support, above resistance. No, it's fixed. And the idea is you're trying to trade mean reversion on a very short time frame using this methodology. Now, If you guys got any ideas or want to adapt and adjust this, then feel free. This is a kind of an idea and theory so that you've got something that can work from. So 2 bars in one direction, which means that this market's a little bit stretched. You know, it's assuming that it's not going to continue. That's our assumption with this. Of course, our stop stops us out if it does. Dan, the Keltner, means that it's just containing price a little bit better over that 20 period. So we've got a couple of things now that are mean reversing in our favor. We're looking to fade that for a push back in. Now, some adjustments you could make. Perhaps you use a midpoint of the Keltner as a target. Perhaps you wait for price to come back through the Keltner and have a stop above. There's some little tweaks and plays you can do, but there's the main kind of foundations of it. All right, guys, that is Forex Scalping with Keltner Channels. See you next one. Take care. Bye-bye.